we probably see 50 companies a week. On a bad week, maybe it's 25. 90% of the opportunities that we see will result in small businesses. A small business inside of a venture fund is almost the same as a zero. It's like, hey, you met this founder. In 48 hours, just decide if you want to marry them, because you're basically signing up for 7 to 10 years, and there's no really good way to divorce. AI, at the end of the day, is going to basically interface with most of the components of your business. If you're not doing it, we're not interested. I generally love two-person teams. I want vision, marketing, product as one typical person, and then ops, finance, structure as another typical person. We over respect our CEO level talent, and we definitely are cautious to jump into a deal with somebody if we don't think they can kind of run the entire game. It's there to basically add rocket fuel to a founding team through providing greater talent and capital. The greatest founders I've worked with are both arrogant about their idea, but they're also the stealers of other people's strategies, and they want to win, and they put that all together.
Yeah, great, Mike. Happy to have you on my podcast about venture studios.
Happy to be here. Thanks for having me, Max.
Yeah, I want first to ask about your story of creating science, how you came up with a venture studio idea or model, and whether you called it initially a venture studio or some other sort of a VC fund. So if you can share a story, would be great.
Sure. So when I after I had sold MySpace, I kind of looked at my career, and I had done early stage startups that I had built myself with my own team. I had done angel investing and venture investing, and then I had run an at scale internet, franchise in MySpace. And I really wanted to do something where I could work with a lot of entrepreneurs, but in a very hands-on structure. So I wasn't interested in the traditional venture model where we just cut checks and attended board meetings. I wanted something where I could really be in the creative process with the founders at an early stage. And so I originally looked at Idea Lab, and I looked at BetaWorks at the time, and then formed Science with my kind of core current team as a platform to basically build companies from scratch.
So you launched together like a venture fund investing externally in other startups and also a venture studio, or like it's primarily a venture studio, but sometimes you also invest in companies that are already on the seed stage, for example.
So it's structured as a venture fund. So technically, we are a venture fund. We operate as a venture studio where we, co-found companies with founders at really early stages. We, acquire large positions in their business through investment, and then we typically stay heavily involved both from the board and at times operational level through their journey. So, although we technically are a venture fund and we have a standard venture fund structure for investors, we operate as a hands-on operational studio.
Do you see some like pros and cons of different models? Like if someone wants to turn their capital into multiple X, how would you recommend them launch a venture fund, a typical venture fund, or launch venture studio? Like for whom those models are great or bad?
I think the venture studio model requires a depth of operational knowledge, especially in the kind of early stages. So I think if you're kind of a technical analyst and you're looking at markets and you want to put a lot of capital to work in a somewhat passive way, I think the venture model is really, really good. I think if you're smart and strategic and connected, that's fantastic. If you have the mindset of an operator and you want to be in the weeds very early stages and you really want to work hand in hand with founders and you have a lot of operational expertise to bring to that dialogue, so you build your credentials with them, you build your credibility with them through your operational expertise, then I think a venture studio is a good option. But I think if you're running a venture studio in a perfect world, obviously you would have built and sold your own companies more than once and have a great experience of kind of going from zero to something successfully and unsuccessfully multiple times. So you're bringing a lot of expertise into that dialogue.
What is the role of a venture studio in launching a company? So I know that you launch approximately about 8, 10, or 12 companies a year. What the studio does, so it invests money into those companies and you have a team, but how you help founders to launch companies?
So the way we kind of do it is we we meet a founder at a very early stage, and maybe it's a single founder or a two-person founding team, and they have some sort of vision. And let's assume that their vision and the market behind the vision lines up with our expertise, which is really in digital marketing, direct to consumer, retail distribution, social, marketplace development, business development, partnerships, etc., fundraising. What we'll do is say, okay, we want to kind of embed our 15-person venture team with your team. And then we want to help you cooperatively run and grow the business, at least at the early moments. We also will provide capital into that relationship. So at that point, we're filling in gaps that they might have. So maybe they have really great product people, but they need some engineering support. Maybe they have great engineers, but they really need some assistance with large scale business development. Maybe they have great business development, but they really want assistance with fundraising. So we're going to complement them in whatever way they need to hopefully help them become more successful. Then, as time goes on, our operational involvement kind of pulls back, and then we kind of take a more formal board-oriented investor approach. No, and the relationship kind of changes over time, right? It just depends on kind of what the company needs. So it might be a company is really involved with us, and then they scale, and maybe they're fully operational. They really don't need any of our assistance, but then they end up in an M&A discussion, or they have a conflict, or executives lead, and then maybe we can come in and we can fill in certain gaps, kind of help them along that journey.
We've published several research papers and reports on family offices, VC, venture studios, and AI. You can find the links in the description and download them for free. We are now looking for family offices and venture studios to participate in our new 2025 study. Find the information in the description. Can you share a bit about like some numbers in terms of equity that you typically take, investments that you do in companies?
No. So our terms are confidential, as you'd imagine. We're early stage, so we're investing at a really low valuation typically. And we typically are investing, single digit millions. But then when we have a big success or liquid death, we might go up to like 80 to 100 million. So we have a lot of scale, but the exact equity terms are specific to the company.
Can you also tell about like whether you have some structured processes of several steps on how you launch companies, ideation, validation, spinning out companies, and so on? Like whether you have some structured processes of divided by several steps.
Yeah, I mean, we're focused on consumer. So whether it's mobile social applications, marketplaces, or commerce, direct to consumer commerce, we look for ways to do really early customer validation. So how can we get something in the market, something actually touching customers that show us that they have positive responsiveness to what we're potentially proposing? That could be a pre-sign up form. It could be collecting emails. It could be a social media campaign. It could be a viral friend get friend system. It could be actually developing the product and putting it in people's hands. It could be signing people up for a test marketplace, but we look for some way to basically test the audience and determine whether or not, we think that this is actually going to connect with audience members. And, what we're kind of underwriting our investment criteria around that audience engagement, because what you kind of is true in consumers, you and I can sit here and we can come up with a concept and we can 100% believe it's going to be great for the whole world, but we really don't know until we put it into people's hands. We really don't know until we tell people about it. If we tell people about it and we're seeing really good positive responsiveness, we still obviously have to figure out the nuance of the product, the way we price it, the way the platform launches, and all the other components. But we get a lot of test data early to understand whether we think this is going to be really hard. It's something that consumers want. And so it's like a pull. Consumers are pulling the product to them. Or is this a push? This is something consumers are not sure that they want. And we're having to push it into their lives. And that's obviously much harder. So we're looking for any way to validate early customer interest in the product before we invest heavy dollars behind developing it.
It's interesting to understand. So once you say like we back cultural movements first, product second, like how you understand that this particular idea is moving the culture, and like what is the criteria how you select ideas?
Well, let's see. So we definitely have a lot of data we use to kind of understand directionality of culture. So if we have a theory that we're seeing play out in real time, then we'll basically create a lot of or find a lot of supporting data or contradicting data around that theory. We pay attention to trends. We're heavily involved in just the general world. Like our team is out, they're doing things, they're meeting people, they're talking to people. So we learn a lot just through obviously personal experience. There's definitely times where we look at cultural movements that we don't think have high scale, right? Where it's like, oh, it's like we can have we have a lot of debate right now on microplastics, right? So if I told you microplastics are in your drinking water, you might be very concerned. You might be like, "Man, I really don't want it." If I told you microplastics might be in your Teflon pans, you might be concerned. What if I told you that every time you wash your gym clothes, microplastics are released from your gym clothes and they stay on the gym clothes as a residue? And then when you sweat, your pores open up and absorb those microplastics into your skin. Will that make you get rid of your Lululemon, your Aloe, your Viore? How comfortable are you? So it's like we might look at a trend saying there's an awareness and concern around microplastics. Then what we have to validate is if we're going to approach that trend, is it a real big concern for Americans? Will it change their spending behavior? Will it change their habits? Will they spend more money to change that? How immediate is the impact of microplastics? How much do they really care about that? Right. So I can bring people factual evidence. That doesn't mean they're going to give away $1,500 worth of synthetic plastic made gym clothes. So when we're looking at these trends, we're also trying to evaluate, are consumers real, do they really care about it? Will they vote with their wallets to change or, complement their behavior? Is it something that's at the top of their mind of kind of how they're spending? And we're trying to kind of figure those out. So we're constantly looking at trends like those to understand if we want to invest behind them. And then we also have to ask the question, like, if we succeed in this, will the large acquirers care about this? Is this a company big enough to be IPO'd on their own? Will it be able to be a large scale, sustainable, profitable company? Will this be acquired for a technology play within another business? So there's a lot of those factors that we kind of take into account when we're kind of determining whether or not we want to invest.
Typically, if you go to some accelerators or early stage VCs, most VCs prefer to invest in B2B companies. Do you think that launching B2C companies is more difficult, and like what type of founders are most suited for launching B2C companies?
I think that like consumer, I think D2C, like direct to consumer, consumer facing companies have to come from a passion of the founder, full stop, right? Like I had a really interesting discussion the other day. I mean, I've been fortunate that I spent time with most of the people that have launched the largest social platforms in the world. And I would argue in many cases, the reason why they designed the platforms they did was in response to the way that they think about humanity and the way they think about human interaction. And the manifestation of that is through software that delivered whatever Snapchat, Instagram, WhatsApp, Facebook, MySpace, whatever. So, for instance, I met someone the other day who has a severe stutter. And they have a really hard time communicating with people, and they've had a hard time their whole life communicating with people through this very severe stutter. And they've built a social platform for communication that is a completely different approach to communication I've ever seen, where they're really replicating human emotions through this platform they've created. This was obviously a mobile app, and it's designed as a social software system. But the reason why they designed it was because they had a lifelong battle with communication and how to relate to others. And because of that challenge in their life, they've now developed a piece of software which actually, I would argue, has a different way of creating communication and human interactions through mobile phones, which I find super fascinating. So they built the product based on a need that they personally had. You and I would not have come up with this product because maybe we don't have a verbal communication challenge, but they did because of this challenge, right? So when I think about people that launch great consumer products, it's typically out of a very personal need that they have and they've experienced in their life. And they're solving this for themselves because it's something they've been wrestling with. And even if though they only started the company 9 months ago, often they've been thinking about this problem for 9, 10 years. And it manifested into this one thing, right? And then the question is, if they had this challenge and they've come up with this really unique solution that's manifesting as a company, how many other people relate to that challenge? And that's obviously part of that consumer testing piece. So on consumer companies, we're looking for people that are personally connected to the challenge and they're really solving this for themselves.
To launch a consumer company, you need to have this problem yourself. And what other traits might be like? How do you select founders to partner with? What traits founders miss that never will launch unicorns? I mean, that are there some red flags that you think some type of founders will never launch huge companies?
Sure. So when we think about the founder, let's talk about two components like the personality traits of founders, and then let's talk about founders that create small companies, right? So if we're talking about personality traits of founders, we're not looking for traditional, well balanced, good grades, check the box, follow the rules kind of people, right? We're looking for people that color outside the lines. They want to carve their own path. They're finding a dynamic, different way to approach society. And they'll have a certain arrogance, right? That their idea is better than everything else in the world. And they're willing to kind of sacrifice a big portion of their life to go after that idea because they're on a mission, because it's personal. The greatest founders I've worked with are both arrogant about their idea, but also wise enough to take an advice from people that have more experience from them and then dovetail their advice in with their idea. I've met founders that I argue are challenged founders when they're super arrogant of the idea and they actually don't want any advice from anyone else because they think their way is literally the only way. I found the greatest founders have a super passion and drive around their idea, but they're also stealers of other people's strategies, and they want to be thieves, and they're thought thieves, right? They're strategy thieves, they're idea thieves, and they complement it to win, and they want to win, but they understand that they may not be the only way. There might be other ways to win, and they put that all together. That's like typically a founder I'm looking at. I don't really care about their schooling background. I don't care about their ethnicity. I don't care about how rich they grew up. I care about their passion on their concept and whether they have the traits that we would see as like someone that might be a great founder. They attract great people around them. They can attract a great team. A blind spot sometimes is somebody sees a problem. They want to be the founder of that problem. But what they don't realize is that's a really small problem, right? So if I have a problem I want to solve and it's a very personal problem to me, I might think it's the greatest thing in the world and I might end up building a very small business, right? And that's just something generally we have to see in society, right? There are certain times when certain ideas do really, really well and they create a lot of money. And those exact same ideas 20, 30, 40 years later don't create any money at all, right? And so you can have the right idea at the wrong time. You can have the right idea and have a small market, and you can be a great founder with that idea and still have a really bad exit or no exit at all. So, there's a complement here between the founder and the founding personality, the concept they're going after, and the receptiveness of the market and the consumer audience around that idea. When those three things come together well, you get big ideas, big companies.
How do you see now how AI is changing the way companies are created? For example, in consumer products, like how do you apply AI to shrink time between an idea and validation of this idea or launching?
Well, let's see. So, I mean, I guess we do a ton of research through AI, right? Like there's no excuse for not knowing the answer to a question at this point, because any question you and I can ask within seconds, we can come up with a fairly informed answer. Not perfect, wrong sometimes, but generally pretty well informed. So at the very beginning, starting with market size, starting with finances, starting with strategy, starting with competitive set, et cetera, we can have more data when we approach things. Makes me really, really happy, right? The second piece is, when it comes to visualization, product visualization, software visualization, interface visualization, logo branding, marketing, etc. Obviously, the cost and timing to do that there should be nothing now. Like no one should be sending us a deck that's like logo TBD. You know what I mean? Like at this point, if you have a concept, you can pull market data and you can have full visuals around that concept within a day. And if you're too lazy to do that, it's just not going to work out, right? So at the earliest stages, from idea to kind of full pitch presentation, AI's transformed that whole thing. The second piece is when you're actually building the business, AI interfaces everywhere, right? So your coders need to be using AI coding tools for sure. It should make everything cheaper and faster than what you've done in the past. Your customer support systems should all be tied into AI for responsiveness. That should be way cheaper than it's been in the past, right? If you're doing complex data, complex algorithms, obviously you're doing AI as a component of that software engine. That's super, super important, right? If you're using marketing data and you're trying to figure out customer overlap, customer segmentation that you're uploading on Facebook, again, AI is going to do a better job than humans at a lot of that stuff. So we expect at this point that AI runs a thread through that entire company, touching nearly every component of the business. Granted, yeah, if you're manufacturing and you're trying to negotiate aluminum prices, the research might help you, but maybe it's actually not going to change anything. Um, but AI at the end of the day is going to basically interface with most of the components of your business. And it's just a matter of how you end up using it. So at this point, if you're not doing it, we're not interested. Um, so that's AI, right? Like it's absolutely everywhere. It's at the heart and the edges of most of these businesses. Sometimes it's on the front end service level. Yeah, it's something we generally expect now. Yeah.
What is the minimum team required to launch a company? So you typically look for two co-founders, but when you start hiring and whether it changed with AI. So for example, that now like 2-3 people can do more than earlier, maybe like 5-10 people could do. And what is the process of growing a new company in your studio?
Like as far as like I mean, I generally love two-person teams. I want vision, marketing, product as one typical person, and then ops, finance, structure as another typical person. That two-person combo group for us is super fantastic. So I love a two-person team. Now, sometimes we end up with the former. We end up with a great visionary product marketing person that we need to complement then with a great ops, CFO, legal structure person. But I think that two-person team at the end of the day is really, really critical. And they don't have to be equal economics, but I think that that two-person team also supports themselves through the hard times, right? I've seen a lot of burnout from single founder companies. Like as a single founder and a group of other individuals with them, and at the end of the day, there's just a lot of burnout. And so I think that two-person core team that's really running the business is really, really critical. And then a bunch of supporting talent that just depends on what the weaknesses are inside the business. So if you and I said, for this business to be super fantastic, we need incredible algorithm specialists. No, no, no. We need incredible marketing. No, no, no. We need somebody amazing at product sourcing and manufacturing. No, no, no. We need distribution and sales, and figuring out those critical components. Outside the critical components, I'm okay with consultants and outsourcing, right? But I want a two-person founding team. I want critical components inside the business, and everything else we can kind of complement.
I expected to hear like CEO plus CTO, but it's probably now more like CEO plus COO. What you
Yeah.
described, is it correct? So
Yes. Exactly. Yeah.
and the product probably you can just hire people for like some CTOs or some engineers to develop the product. Or in your case, it's less like development and more consumer products.
No, it's both, right? So our marketplaces are software driven. All of our social media mobile stuff is software driven. CTOs become super, super critical. On the CPG side, CTOs are less critical. But yeah, so it's like 100%. It just depends on the business, right?
Do you think that there are such people whom you can just hire and have the same quality of CEO or CO, or it's just like two different types of people when you hire and when you are looking for great founders?
I mean, I think at the end of the day, it depends heavily on the business. You know what I mean? So I think if you have a business that's easy to execute in SaaS, in biz dev, that's not necessarily consumer, I think it's a lot easier. If you're coming at scale, oh, it's going from 20, 50, $100 million revenue and growing up, then you can do this. I think if you're at the early stages and you're on the consumer side, I think you need a passionate founder. I think it's hard to place a founder at that point. You know what I mean? So it depends a little bit on the company and the strategy.
And then in terms of age of the founders, so you on one podcast you mentioned that some like students are more, they're uniquely positioned to be expert social media marketers than other people because they live in what's next or they like always are in social media. Do you think that for some types of companies it's better to find young founders, and for some it's better to find some experienced founders with 15, 20 years of experience?
I mean, I think if you and I were saying, okay, we're going to do a roll up of nationwide accounting firms and create a national brand, and there's a financial arbitrage and it's M&A, then yeah, having experience on how to buy and integrate, companies, work with private equity, leverage debt, 100%. If you and I are saying, we're creating a competitor to WhatsApp that's going that's going to be focused on junior high and high schools. And we want it to be a positive social media platform with anti-bullying provisions, but we also want it to be super viral. Then, like at the end of the day, you're going to want a really young founder that's super connected to that audience and connected to the tools and the platforms where they currently live and exist. So I think it just depends on the business and the business executable strategy. I think in CPG, yes, like Liquid Death required, the CEO who is the current CEO, obviously, and an amazing visionary to like have that brand positioning. Like Mike Cesario was epic at understanding that brand, um, and he also, was, you know, trained and learned the CPG business, the manufacturing business, the shipping business. Like he expanded as a founder. In some cases, um, I think, experienced founders in CPG add a lot of value because although they may not understand the brand positioning for a youthful audience, they understand the technicalities of manufacturing and distribution, which is why I think you have visionaries like Mike Cesario then partnered with experienced operators, and that creates a really powerhouse team.
Do you have some approaches, or like what is your approach to hiring? Like what you're looking for? I'm not sure that you hire now, that like you have a great team, but what is your initial approach to hiring? What you're looking for?
Like on the science team.
in size team or just for startups? So like you launch startups. What is your advice to for startup teams to hire?
For startup teams, I mean, I think first off is it's better to not have overlapping talent. I think people need, um, you know, I think people need their lanes of specialty, right? So you want one person focused on marketing, one person focused on product, one person focused on ops and finance. I don't think you want a lot of overlap. And sometimes I find founders are attracted to other founders that have the same skill set. Oh, we both think the same way about product. I'm like, that's actually, I think, hard at scale. Sometimes it works, sometimes it doesn't. So generally, I prefer founding teams where people have clear lanes of responsibility and there's not a lot of overlap with other people. The second piece is I think you need a clear line of communication and decision making. We see very few companies succeed when they run as a cooperative. In most cases, you need a CEO with a line of reporting, a line of structure, um, etc. And I think you need to have, you have to understand that there's a structure in place that is a decision making structure, and there's one person at the end of the day that has the final call on it. I think they have to respect that. And sometimes when you have these really young founding groups coming out of college, they have kind of this communal mentality that they're all going to run this stuff together. There's edge cases when it works, yes. More often than not, I've absolutely seen that fail, where there's conflicts and people can decide, and there's not a decision making process, et cetera, et cetera. So, I think I want clear lines of focus, and clear lines of focus and specialty matched with a clear, structured decision making process. I think that ends up being a good combo.
It's like team construction, but when you are hiring for, let's say, product position or like a marketer, will you look at their previous experience? Will you conduct some tests on their mental ability, or will you look for their experience 0 to 1, or like what do you think is critical in terms of when people hire in startups? uh, do you have some sort of a framework on how to evaluate candidates, let's say for typical positions like marketer or product manager?
Yeah, I mean, I think look, obviously, one thing that's really challenging about startup is in all cases, you're dealing with limited budget, even at scale, right? You have a company that's doing 300 million, they're still budget constrained, right? So you're working in a budget constrained world for sure, which means that generally you're not going to get the talent that you're not going to get the most expensive talent, right? If somebody's out for capital cash, they're going to end up at Google, Facebook, OpenAI. They're going to get overpaid by somewhere else, right? Which means you're really looking for passion, right? Early stage companies are looking for people that want to go on the mission with the founder. And the founder is super important here, right? Because people work for their boss fundamentally. They don't work for the company, they really work for their boss. So you need to build a cult. You need to build a team of people that are on a tangible mission that they connect to. And they're willing to sacrifice their time and sacrifice some level of compensation in this startup versus them going to a traditional company where they would typically be paid more with greater benefits and probably have an easier working schedule, right? So, in a world where you can't get the most expensive talent, you've got to get the most passionate talent that really believes in the mission of the business, because they got to be doing it for more than money, right? And so, and if they're working with the startup because of the flexibility and the lifestyle, and they don't want to be under a corporate enterprise, I'd argue that's the wrong reasons to be there. You don't want to be there because you're a work at home culture and somebody can really check out for 2 of the 5 days of a work week and not actually work. That's unhelpful for you. You need people that are on the mission, and that driving force of that mission and that founder broadcasting that mission and driving talent behind them, that might be for like 5 or 7 years, could be 10 years of that messaging, which is also why when we think about founder credentials, they have to be able to put people behind them and attract epic talent to kind of come and work with them, right? Because they're not going to have enough money to go buy the best talent. Companies can go buy the best talent. Founders have to inspire great talent, which means that they have to be on that mission and they have to broadcast that mission and excite people that want to be on the mission with them. They have to come there for more than capital.
Let's talk again about venture studios. So venture studios typically struggle with fundraising because most LPs and most family offices and funds of funds, they don't understand the concept. And how you typically explain what is a venture studio for potential investors?
I mean, a venture studio is in essence a team of operators that complement a founder to more rapidly test and build a company from scratch. That's fundamentally what a venture studio is. The venture studio is not focused on turnarounds. It's not there to honestly fix problems. It's there to basically add rocket fuel to a founding team through the through providing greater talent and capital. And the result of that would be that that team and that idea will either get to scale faster, will take less dilution, will end up with more fluid fundraises, or will rapidly know the concept isn't going to work, and then the team can go work on something else. So I think it's just it's basically adding talent and rocket fuel to a concept to determine quickly whether it's a concept worth investing in and pursuing. And that honestly saves investors and saves founders time and dilution.
Do you also encounter that typically like LPs that invested in VC funds, they don't understand the model, or it's harder to pitch the venture studio models than a typical fund, or like what is your experience in terms of communicating with LPs?
I think the LPs that understand. I mean, I think when LPs look at venture studios, the way that they probably see it is it's just a very early stage venture fund that has high operational cost, right? It's instead of fees generally going to the general partnership, fees are being spread across a larger team. People are being, in essence, compensated less. But the return is that we should have a higher success rate and we should have larger ownership over the businesses that we're investing in and spending time in, and we should get better terms. So instead of us going to market and competing over a $25 million pre-seed round, we're investing at a way lower rate. So from an investor perspective, it's a fund with early stage exposure but greater than normal pricing leverage, which means that in the wake of success, you just have greater returns. So if you say, okay, there's a seed fund, a seed to Series A fund with some follow-on capital, and let's say that they're investing in market competitive against other funds, which means at the end of the day, pricing is the question. What is the fund A going to give them versus fund B if you're a deal? Which means that we're just in a price war, right? And which means that it's a lower return for the investors because of the competitive field. Those prices are going to go up. The entry pricing go up versus a venture studio, which is finding somebody before they've entered that price war. The founders choosing to work with that team because of their strategic and operational assets. And in return, they're going to let that fund invest at a better than normal price, a below market price. So if you say that if there's a standard seed fund and there's a venture studio and they have the same number of companies, let's say they have the same percentage of hits. So they have 30 companies and they have 3 hits or 2 hits out of it. The venture studio performance should exceed that of the seed fund because the venture studio was able to invest at a better valuation, a below market valuation versus the seed fund.
Here's the question: whether you encountered some problems with follow-on capital for startups, because you got like more equity on cap tables that typical pre-seed or seed funds have. Because I heard some studios, they complained that they even needed to adjust their equity on cap table in order to get, like, let's say Series A or Series B around. Do you encounter the same, and whether you think that there is some uh, pessimism of VCs about companies that go out of studios?
I don't think there's a pessimism on VCs. I think that some studios, especially studios that are not US based, um, o- often have very non-standard terms, right? So what we've done, I mean, I can't even, we've done like 150 companies at this point. Even if we can gobble up, 50% of the company at early stage through really low pricing, what I know is that puts that company in an unfundable position in venture capital world, right? In any case, whether you're a studio or a seed fund, there's only so much equity you can own at the early stage in order to leave enough room on the cap table for the founding team and a cap table that will scale over time as dilution comes in through subsequent rounds. So even if the founder loves the studio and wants to give the studio immense amount of economics, it will probably prevent a future round. But we've seen this before, right? There's definitely startups that have gone and raised from doctors and dentists or non-traditional venture investors, and they demand really, really high, dilution. So what we found is you find some company that's not in Silicon Valley, they're not in LA, but they've been successful and they've raised from non-traditional investors. Those traditional investors might own 80% of the company. The founder might own 10, there might be 10 as an option pool. The founder's happy. They're like, oh, I've done a great job. These doctors and dentists, they've come in and funded my business. It's great. But you and I look at that, we're like, wait, You've already sold 80% of the business to doctors and dentists for like $250,000. You have a scaling company. We can't raise money into it because you'll be diluted. So we have to go and reset the cap table. So whether it's a studio or just non-traditional financing, anytime you end up with a perverted cap table that doesn't fit kind of Silicon Valley, venture standards, you end up with a really hard fundraising experience, maybe an impossible one. And I think sometimes studios do take advantage of that because they put in non-traditional terms, and some angels do as well. But then at the end of the day, it just hurts the company in the long run.
It's interesting to hear your like how the venture studio perspective changed from like 20 since 2011 until today. Like what you did you do differently earlier and that you changed your mind now? Whether there were some lessons or some ideas that you think when you started it seems one way, but then you decided to change the concept.
Yeah, I mean, there was a point in our evolution where we had to make a choice between what I would consider like a consolidated holding company and a venture fund. And it's funny because I met yesterday with a fellow running a studio, and he's basically running us a consolidated holding company. So he has like an LLC, and they own minority and majority positions under a single entity. And we did that for a spell and realized that basically it was an unfundable structure. The US has a very complicated tax code as it relates to companies owning lots of little companies. In fact, the tax code is so unfavorable. I'd argue that it's really hard to do efficiently, and there's not a normal investor, scalable investor base for it. So it's one thing. This group I met with yesterday happened to have a single LP that would just fund everything for them at pretty good scale, so they can kind of get away with it because they don't have to go to market to pitch. But if you have to walk into so the first thing I say is structurally you have to build at the end of the day, our studio is a product, right? And that product is sold to LPs. And then the results of that product is also sold to, founders. So we have to have a product that LPs can buy. Pretty simple. We have to have a structure that LPs understand, right? And if we don't adhere to that structure, it's hard for them to understand, which means that they can't invest because most LPs are following very specific investment criteria. And the bigger LPs you go to, the less abnormal they want that structure. So the first piece is make sure you're structured in a way that you can actually raise capital efficiently. Because if you mess that up, you're gonna have a really hard time, even if you're successful, right? That's one big change for us is like fully, and we obviously embraced this change like over 10 years ago. Um, the second change for us is just because I happen to have a really good team that's epic at building companies, it doesn't mean I can turn everybody into an entrepreneur. You know what I mean? It's not like I can take somebody that doesn't, I can't. There's a certain component to vision and strategy and execution and operations that really does have to come from the person. And so no matter how good we may think we are, the reality is we need a great complementary individual that's going to that's going to basically help us. That's going to basically drive the vision. So, we over respect our CEO level talent, and we definitely are cautious to jump into a deal with somebody if we don't think they can kind of run the entire game. So, I don't have an arrogance, or I've lost any arrogance on like I can help someone become something. At the end of the day, like there's internal components to being a CEO and being a founder that we just can't teach, no matter how smart we think we are. So that's a change for us. The third is, I think, and I asked this. It's kind of like that very classic question: is if you think you couldn't fail, like what would you do? And one thing that's definitely true is, because we see so much, we see opportunities everywhere, right? But 90% of the opportunities that we see will result in small businesses. And, a small business inside of a venture fund is almost the same as a zero because if I end up with a company that's doing 12 or 15 or 20 million in revenue that we can't sell, that isn't throwing off a meaningful profit, like it's basically a zero, right? Because in a venture fund perspective, we don't get paid, right? We're not on staff, we're not on salary. My LPs don't get allocation off of you know, salaries off of these companies. So in a certain sense, in the venture world, you're either going for absolute bangers, absolute $1 billion plus exits, or you really shouldn't be doing venture, right? Because a handful of 15 to $25 million profitable companies with no clear path to exit or massive profit release doesn't really help your LPs at all. So, yes, we're in a world where science as a team sees a lot of interesting opportunities. 90% of them will not return substantial amounts back to our investors. And so we just fundamentally have to pass on them.
Second lesson, you mentioned that you understood that not all people can be entrepreneurs and you have to select people very carefully.
Hmm.
um, those people who have probably passion, those I want to ask, like, whether you're looking only for founders that already built companies previously, or those can be the first time founders.
I mean, well, first off, is we work with a ton of first time founders, and we also do work with a whole bunch of we do work with a whole bunch of second time founders too. So we're absolutely open to both. Yes.
Is there any checklist to understand whether a person is passionate about the idea, or whether they have necessary skills to grow this company to huge business?
I mean, I wish I could tell you there was some like clear checklist. There's kind of not. I mean, like, yes, there's a series of questions we will ask founders, and there's a series of discussions we'll have, and but at the end of the day, time is what tells you. You know what I mean? And so we love time where we can work with these founders over a substantial amount of time to become comfortable that this is truly something they want to commit a long time to. I mean, uh, you know, startups last longer than most American marriages, if you think about it, right? And so what's funny about venture capital is it's kind of saying get married before dating. It's like, hey, you met this founder in 48 hours, just decide if you want to marry them because you're basically signing up for 7 to 10 years, you know, and there's no really good way to divorce, just to be candid, right? It's like either the whole thing implodes or maybe successful. Maybe there's some opportunities to sell secondary, but fundamentally it's pretty limited. So we like time. So we often start working with founders and we might work with them for 6 months before we actually fully invest, right? Like we'll spend time with them, and part of that is it's twofold. One is, do they like us? Do they think that we add value? Do they really want our advice and involvement? Um, and if not, that's okay. Like let's learn this now. And the second question is this us evaluating them? Is this really somebody that we think can go the distance with this vision? Is this really the vision they want to go after? Are they going to be distracted by other things? Which we saw, right? We saw a ton of founders like ditch their startups for crypto, right? Because they were like, oh my God, there's more money in crypto. Let me just jump. And then you're like, oh, well, then you weren't in it for the vision. You were really in it for the money, right? And which we lost. I mean, the venture ecosystem lost a lot of talent to crypto, like a lot, because there was fast liquid money. So it's like, how do you compete with that, right? Um, but so for us, it's like time. We want time with founders to understand this is the vision that they really want to go after. And we want them to have time with us to understand that we're going to be the complementary team that's going to help them, execute their vision and that they're going to have faith with it.
And then about building companies, so you typically do research and understand whether this idea can be a very huge idea or not, or whether there is some sort of, like, how you decide that some of the companies will never become huge ones. And sometimes there are some examples when first it's like a 15, 20 million revenue company, but then it continues to grow, and like all people that passed on it, they think, oh wow, I never thought that might be a 200 million or more. So whether do you just like count total addressable market and or there are some additional criteria how you look at the potential size of a company?
I mean, definitely we look at total addressable market initially because there's definitely markets that are just fundamentally small, right? And like even if they double, they're still small. And very few companies will ever achieve more than 10% of market share if they're lucky. So if you're looking
Mm-hmm.
at a $1 billion market, which means your total addressable growth is going to be 100 million if you're hitting 10%, it's like maybe that's just fundamentally not big enough. So that can wipe out a lot of strategies. The second piece is like we talked about with microplastics. Okay, so if you and I were looking at microplastics in laundry detergent as it relates to like synthetic clothing. Okay. Well, laundry detergent is really, really big, right? If you and I had a solution against microplastics in laundry, the question is do consumers care? And then the real question is, do consumers care today? And are they going to care tomorrow? Right. And that's when you kind of get into kind of this venture risk, right? Which is saying, okay, I want to build, like, there's a bunch of stuff we're looking at Hollywood. So I think Hollywood's about to see a major shift. And I think the legal industry is about to see a major shift. I think AI is going to eat both of these industries. And I think they've been industries that, frankly, venture capital has been a hard time attacking because we didn't have the tools. We have the tools now. We can go straight after Hollywood. We can go straight after legal. Now, if I look at those two industries, I can write out on a map 10 things for each of those industries that I think will be fundamentally disrupted by technology, right?
Mm.
But those things are going to require, in this case, AI technology to advance at a certain pace, and B, the industry to accept at a certain level, right? And C, the government not to block certain things, right? So we have three variables. Now, if I'm right and those three variables fall in our favor, I think we could build $1 billion plus business today that will be valued at $1 billion in a few years and have a really clear path to exit. But if any one of those three things don't go in the direction that I'm anticipating, we might end up with a company that's worth zero. It's a perfect kind of venture bet in a certain sense, right? Because it's very polarizing. Now, a conservative investor could say, well, you have three variables you do not control. You do not control the evolution of AI tech. You do not control government regulations, and you do not influence whether Hollywood or legal industry will or will not accept the solutions you're building. So that's three variables too risky, right? But you can decide whether you want to surf for that wave that you think is coming, right? So there's certain businesses we attack where the need is today. We think consumers are drinking less alcohol. We think they want cooler, alternative, healthier beverages. Thus, Liquid Death is a today business. And I think it'll continue to be a tomorrow business too, right? People want healthier foods, and there'll be a 10, 20, 30-year shift, especially in America, back to healthier foods, more natural ingredients, less synthetic stuff, lower sugar, et cetera. There's just a big trend that we can ride there, right?
Mhm.
But there's also waves where it's zero swell right now, but in 3 years it'll be a giant wave. And do we try to position for that? So I kind of evaluate both those things.
Mm.
Near-term opportunities to have clear metrics today, long-term opportunities where we're really taking a bet of what's going to change in the future.
I mean, how many founders do you work with each year? And what is your funnel? I mean, that initially you get like 1,000 applications, or I don't know, 500 applications. Then you work with top 30 founders, but finally you invest in 10.
We work with it's called six companies a year, right? Sometimes it's up to 10. We probably see 50 companies a week, right? On a bad week, maybe it's 25, but we probably get 25 to 50 companies a week talking to us about their ideas or whatever. Um, so you can kind of go through that ratio of what we look at. And I would say out of the six companies that we work with, we we probably talk with 5 times as much to try to get into a term, maybe 3 times as much. So if we're doing six companies a year, we're probably actually talking about terms to 18 companies, right? And trying to get them to that point of wanting to do a business with us. Yeah.
Only after you decide, okay, let's invest in this company, you start working with them together, or you work with them earlier before you invested.
We typically extend the term sheet and begin working with them and fund it along the way. So we have kind of a two-step process with it. But yeah, and that's for, like I said, it's safeguards on both sides. It's like, does the founding team like us, and do we think that the founding team is gonna be effective, right? And so we want a two-sided opt-in to this relationship, which honestly I think is super important, because I think if you don't do that, you end up with investors that may not get along with the founders, and you might end up with founders that don't get along with the investors, and then suddenly you're married, and that's just not great, right? So that's the kind of way we think about it.
You typically invest in six companies. Do you invest in some companies that you don't partner with or don't work with, or like all companies you invest in, they not only get your capital but also your support?
Everything we do, we provide support for. So although from a funding perspective, we do have the ability from our investors to invest into businesses that we're not getting involved in, where we could just participate around. Yes, that's possible, but in most cases, and almost all of our best cases, we um, we invest in companies that we're operational with as well. We think that's super important.
Out of those 150 companies, how many of them have your science came up with ideas, or you only work with external founders that already have an idea and pitch you, and then you work with them?
Right now, it's about two-thirds external founder concepts and one-third our ideas. Yeah.
What advice can you give to studio founders, existing ones and those who want to launch a venture studio?
I obviously love venture studios. It works really effectively for me and my skill set. It does not work for everyone. So I think first off is, if the difference, an investor is just giving money, and a venture studio is giving money and a lot of operational advice. So first off is, I think, make sure that you're in a good place to give that advice, because if you give bad advice, you can really damage the business and the founder, right? So, I get a little cautious when I see venture studio groups, that basically don't have great experience building and selling companies, but they're providing a substantial amount of advice and influence over specific businesses and founders. And my concern is that those founders might be getting really bad advice. And my other concern is that, one of the reasons why those venture studios are being set up is because the founders of the studios want better than normal economics, and so they're looking for a better way to drive their returns, and so they're kind of promising certain things that they may not be able to deliver. So I think
Mhm.
that could just be dangerous, right? So
Mm.
you know like, if you're signing up with a venture studio and you look at the founders' backgrounds and you're like, yes, like, the way I would think about it is, if you look at the founders' backgrounds of the studio and you say, if this person was in the market, I would love to partner with them on building a company. Like, I would bring this person in as a co-founder because of
Mhm.
what they've done in the past, not because I get along with them and they're cool when they hang out, but because I look at their history and I'm like, oh wow, like, this person has crushed it, and I think they could crush my concept. Then yes, that's a great person to partner with. Give them better than normal economics, get involved in the studio, sign up. But if they're just saying, hey, I'm a check, and I think we can do this and think we can do this, then I just don't think you want to do that. You want to really make sure who you're surrounding yourself and influencing yourself with, because they're also going to have a lot of influence over you. And so you really, really want to make sure that you trust what they're going to provide you. So that's just a general piece of advice.
Super. Thanks so much, Mike, for
Yeah.
for your leadership and thought leadership on the venture studio model. I
Yeah.
also see you create a lot of content, video content for about entrepreneurship and building
Yeah.
companies, and so inviting the audience to follow you
Yeah.
on
Yeah.
LinkedIn,
Happy to. I mean,
Instagram.
yeah, Instagram. I'm mjones1, mjones1 on Instagram, and yeah, I publish a ton of stuff just around my lessons in entrepreneurship, the way I look at certain businesses. I love doing that stuff, so I'm super obviously happy to share my knowledge.
Mhm. Okay, super. Thank you.
All right, thanks so much.